Hello, everybody. Ed Yardeni here. Thanks for joining me. In case you're wondering what I'm wearing here, I got jealous of all of these young podcasters wearing hoodies. So I decided to wear a hoodie, and especially this one, which has a picture of Max on it. Max is one of my three puppies, as you probably know. Every now and then he makes an appearance. Right now he's not in my office, but you never know. Chloe might show up. She usually likes to go out exactly when I'm doing these podcasts, as I'm sure some of you have seen, and as I try to accommodate her anyways. So without further ado, let's talk about events up ahead here in terms of the financial markets. Let's share the screen. And here I am. Though I was looking at them before, so let's scroll up here. Okay, so today's January 30th. It's Monday, and this is a live webcast. We'll have some Q&A here along the way near the end of my presentation. But as you know, this is a interesting week. We are going to have lots of employment indicators, lots of earnings. And on top of all that, we've got the FOMC meeting on Tuesday and Wednesday. And we know that the Fed chair will be presenting in its press conference an overview of what was discussed at the FOMC minutes. It's widely anticipated that they will be increasing the Fed funds rate by 25 basis points. There's some talk about 50 basis points, but we'll see. We'll have a couple of indicators that might be relevant. For example, on I think it's Wednesday, or maybe it's Tuesday, we get the JOLTS report, and that will show the number of job openings. I think it's going to be heading down somewhat, as you might have seen in the QuickTakes, which gave you a chart of the job openings according to JOLTS versus the small business survey that is more timely and suggests that job openings are coming down, but still remaining extremely highly elevated. I think what's going on here is we're seeing the workers just quit more often. They don't like their jobs. They want to get more pay. They're flighty. I mean, it hasn't been good for my productivity story, clearly, but it is what it is. And as people are quitting more often, you've got to post job openings more often, and they tend to increase. So I think a lot of what we're seeing here is churning in the labor market, but the Fed is focusing on job openings as one of the key indicators. Later in the week, we'll get the employment report. Initial unemployment claims suggest that the labor market still remains quite strong. So we'll see how all that plays out. But I think everybody's a little bit nervous here about whether Jerome Powell is going to smack down the market with a very hawkish outlook on Fed policy. I think it's more likely that he'll just reiterate what they've been saying all along, that they're getting closer to restrictive. They may have some more to do in terms of raising the Fed funds rate, but they are in restrictive territory. And that once they feel like they've got the right number, and I think that number is, well, as far as we know right now, it's 5.25%. So that's 25 basis point hikes in the Fed funds rate over the next 3 meetings, let's say. Then I think Powell will indicate that they'll pause or still maintain that 25 basis point increase per meeting if they don't feel that things are going quite the right way. But as I'll show you now, I think things are going the right way. We've got an economy that's still growing but slowing. We've got inflation that's moderating. But let's here look at this chart of the market. You can see that there's, oh, let me turn that off. Okay, sorry about that. Oh, let's see. Okay, turned off the light, but not the sound. Now we can proceed with without noise. So as you can see, the S&P 500, as you all know, was in a bear market from January 3rd to October 12th. Many of you may think that the bear market's not over. I think that the bear market ended on October 12th. There was a tremendous amount of pessimism back here on the outlook for the stock market and the economy. Remember, there's a lot of talk about a recession last year that didn't quite pan out. Turned out that the economy turned out to be stronger in the second half of the year than it was in the first half of the year. But there's no official recession likely to be ever marked for 2022. So we gave a shot here a couple of times to get above the 200-day moving average here, here again. And now, late last year, we had a shot at it. But I think all of them were associated with Powell turning increasingly hawkish. And maybe he's got this chart in his office and said it's time to knock it down. So we'll see where we are now, because we're above the 200-day again. And the markets are concerned that he might smack it down. But then again, it may just be that Powell will say what we think he's going to say, 25 basis points, a little bit more to come, and then they're going to keep interest rates high. They're not going to lower them. The market can live with that. And maybe we'll move still higher. But when I tell you that, when I say that this was the bear market low, doesn't mean that I believe that we're just going to go straight up from here. I mean, we could have quite a bit of volatility going from here, but I think we're no longer in a momentum market, which is what we had here when the Magnificent Eight, the mega cap 8 stocks, were leading the charge to the upside. And I think we are in a stock pickers market. That doesn't mean I don't have opinions on which sectors are likely to outperform. Won't keep you in suspense. I think industrials, energy, materials, financials, those will probably be the outperformers this year. And they reflect our view that not only is the U.S. economy not going to fall into recession, but and maybe just have a soft landing or just slow growth, but it's also our view, and it's become clearly consensus, that the global economy is not going to be as weak as was feared. No recession in Europe, no recession in China. This you can look at on your own, just kind of shows where the performance derby has been since the beginning of the year. And clearly some of the cyclicals are doing very well so far. It's also interesting, as I've observed a few times, that the breadth of the market seems to be broadening. Equal weighted over market cap weighted has been moving to the upside here. It's actually higher than it was before the pandemic's recession. And then you can also look at the advanced decline line and the New York Stock Exchange by volume, and you can see that we had a downward range back here going, what is it, kind of first half of 2021. And now maybe we'll see, you can draw yourself a line in your mind here that maybe we're going to break through that. And that would be another important sign that things are broadening out. And if the market continues to have an upside bias, and as I'm thinking I might, that would all be kind of supportive of the notion that the worst is over. But then again, there's always something to worry about. And the bears have been saying that last year was the year where we got punished on the valuation multiple. Things were overvalued, and now they've come down. So sure enough, the S&P 500 forward PE came down from 20 at 21 at the beginning of last year, and then got to a low on October 15th of about 15. October 12th, I should say, I got down to a forward PE of about 15. And now we're around 17 and a half. So the valuation multiples are, they're not the kind of multiples you get at the end of bear markets. Usually you get 8 to 10. Seeing 15 to 17 is quite unusual. But then again, everything's been unusual since the pandemic. But if you want to worry about something, clearly earnings are something to worry about. And as you can see, they continue to get cut. Joe just told me that we have data now through the week of the 26th, and it continues to show that these things are getting trimmed down to the downside. Obviously, we're in the fourth quarter reporting season, and the fourth quarter numbers themselves don't really matter at all to the extent that you agree with us that the market discounts earnings on a 12-month forward basis. So it really doesn't matter what fourth quarter numbers are. However, it matters the extent to which they influence guidance. And as you can see, the guidance is such so far that analysts are continuing to lower their numbers. And last week, of course, was the Microsoft week where we had some disappointments there. So these things continue to get trimmed. The good news is the market does look forward. And so forward is forward earnings. And forward earnings are a time-weighted average of analyst consensus expectations for this year, which is this number here in blue. And then that's time-weighted average with next year, 2024. And what's really a thing of beauty about the market is it does kind of look forward. And what we're going to find out is every single day as we approach 2024, we're going to be giving more and more weight to this number. And again, sometimes people ask me, how can we have a bull market if earnings expectations are going down? Well, they tend to be too high when you look further out into the future, and they do have a tendency to move downwards. But look at where the value is. The 2024 is still like $251. The 2023 number is $227. So they're all higher than as you can see here, we had $219 in 2022. So they're all still higher. And unless if you think there's going to be a hard landing and that these numbers, especially this one for 2023 is going to be lower than 2022, then you think we're in a bear market still. Earnings are going to get whacked some more. Valuation multiples are going to get whacked some more, and the market has a lot more downside, 3,000, 3,300, maybe lower in some of your estimations. But if we have a soft landing and this forward number starts, it's edging down, but it starts to stabilize as we give more weight to 2024, which could be like cut some more, then at least on the E side, we're not going to have a hard landing. This was somewhat encouraging. Joe did some clever charts here on the percent of S&P 500 companies with positive 3-month percent changes in forward revenues and forward earnings. And it certainly looks like a cyclical recession kind of move, but here it's bounced off 50% so far. And we got below 50%, as you can see on earnings, forward earnings, and we bounced off of that. So we're not doing this yet. I don't think we're going to do it, but again, it depends on which camp you're in. There's the hard landers and the soft landers. That's kind of like one of these tug of wars. So figure 9. Now we're going to be talking about the case for a soft landing, and I think we'll start out with the global economy. We've said this before. Europe was supposed to be going into a recession because of the energy crisis that was triggered by the Ukraine war. The Chinese economy was supposed to go into recession because of zero COVID. But as we've discussed before, both areas are looking better and better. And what's happening now is the global economic outlook is looking better, and investors around the world are concluding that maybe it's better to start going and investing overseas. As you know, I've been talking about TNEC for a while here. There is no alternative country. Well, apparently investors are feeling more comfortable about investing in Europe and China and some other places around the world. So we've seen that the dollar, this is the JP Morgan dollar, trade weighted dollar, and you can see it's come down significantly since I think late October. Everything seemed to have happened in October. The stock market bottom, the bond yields have been coming down, and the dollar's been going down. I think a lot of this is the global economic outlook is looking better, and that's what's weakened the dollar. Whether you look at it on a JP Morgan basis, or whether you look at it on the basis of the currency that the dollar index that MSCI uses to do its indexes. So here we have the relative performance of the US MSCI to the all-country world in dollars. The weak dollar clearly has contributed to this sharp decline here. And we've indicated that we're certainly willing to, for the next 6 months, go global and pick some opportunities that are cheaper over there than over here. And so we really have no problems with going global. That doesn't mean, I guess it does mean, at least for the short term, to overweight the rest of the world relative to the US. But I'm not convinced that this upward trend is necessarily broken, and that the US needs to be underweighted for the next 10 years. These things do tend to run in long cycles. This was a situation back when the BRICS were the dominant investment game. And as a result of that, this ratio declined. And ever since the great financial crisis, the US has been the place to be. Again, when you look at valuation multiples around the world, the US is no bargain compared to the rest of the world. But some of that overvaluation on a relative basis is clearly still related to these mega cap 8 stocks, which still have fairly high valuation multiples, but they've had their comeuppance. And we've seen that people have been willing to broaden their outlook when they think about the markets. Again, looking at the global economy, I think that a weak dollar and some pickup in commodity prices. We're not yet seeing it in the Goldman Sachs commodity index. That's the blue one here. It's because it's got 60% energy in it. But certainly we've seen this surge in the CRB spot price index for metals of late. And that's a pretty useful, trusty indicator of what the global economy is doing. And right now, things like copper, steel, those prices have been coming up, reflecting the fact that people perceive that the global economy, as it turns out, isn't going to be as weak as was widely feared. Let's go back to the US of A here, and you'll see that we had a pretty good increase of 2.9% in real GDP in the fourth quarter. You'll see that final sales were up 1.4%. So the press picked up on this number and basically said it was a strong number, following 3.1% in the third quarter. However, final sales was up only 1.4%, and that's because half of that strength in 2.9, or a little more than half, 1.5 percentage points to be exact, was attributable to inventory accumulation, which is what you can see here. So manufacturing inventories climbed substantially, and in real GDP, it's the change in these bar charts that get in. So when you go from a minus number in manufacturing in the third quarter to a plus number, that boosts the real GDP. Wholesale inventory is kind of flattish, but accumulating. This is interesting. The retail ex-autos have actually been declining. So a lot of the inventory buildup occurred in the first half of the year, according to these data. And as you can see, the retailers have been discounting to clear the decks and get rid of these things. That, I think, is what led to this kind of backup in wholesale and manufacturing. They were all expecting that the retailers would continue to order, and instead retailers kind of slammed down the brakes when they realized that they had more inventory than they wanted. Auto inventories not much to say there. So again, when we look at the GDP numbers, we see a rolling recession. We see that the recession has rolled over the manufacturing sector because of goods. So goods spending by consumers has been kind of trending downwards. It was a little bit up in the fourth quarter, but that's been offset by an upward trend in services. So consumers, sure enough, pivoted from goods following the pandemic. They had this big spending binge, cut that back, and went more into services. They were able to do that partly because the personal saving rate accumulated, led to an accumulation of excess saving back here. Then they kind of worked through that excess saving. And now the pessimists are saying, well, that's it. Once they run out of excess saving, the consumer is done. And my response to that is not so fast. There's the labor market remains strong. There's still employment gains to be had. And wages are actually rising faster than prices recently, which may very well continue. We can see that in disposable personal income. Nominal terms doesn't tell you much these days because of inflation. When you take inflation out of disposable income, when you look at the real number, you see that, yeah, I mean, over the past couple of years, disposable income went down. So clearly they did rely on that excess savings. But look at disposable personal income now, it's rising. And that should support consumer spending this year. We've had a rolling recession in the housing industry. This is the GDP numbers on total residential spending, and it's come down hard, mostly because we've seen a big drop in single family construction. Multifamilies kind of holding up. Home improvements are weakening. But I don't think we've got anything like this ahead of us. There's a tremendous demographic demand out there. My daughter is in her 30s with her husband down in Raleigh, North Carolina. I just can't kind of follow her as an indication of what the younger demographics looks like, because she was living in California, decided that's not where she wanted to be. She went to Phoenix, stayed there for a year because it was too hot. And now she's moved to Raleigh, and she's very happy with Raleigh. She's got a great job, and she's been renting a house. As you know, a lot of these companies have been buying houses and renting them to people like my daughter. And now she says they're looking at a house. And I said, well, what's going on in Raleigh with home prices? She said to me just yesterday that prices were like $400,000 to $450,000, down by about $100,000 to $300,000 to $350,000. So, those $450,000 prices were kind of real temporary. It was a big spike up, and now they're spiking down. So it's not like anybody's really going through some disastrous deflation in the housing market. They're just not getting anywhere near what they thought their houses were worth when there was this pandemic demand. By the way, she also happens to be, I'm pretty proud of her. She's doing very well in a hospital organization as an executive. And she tells me that, the younger folks that she's hired just keep quitting. So they just constantly have job openings posted just to deal with the quits, and somehow or another they manage with all that. Capital spending in GDP looked pretty good. The structures was weak. The intellectual property is strong, and the equipment, I think it edged kind of sideways, but it's near an all-time record high. Capital spending, high tech as a share of nominal GDP is running around 50%. So, and that's an understatement. I think it's more like 60, 65%, because we're not including industrial equipment in here. And a lot of industrial equipment, what is it but tech hardware and tech software? Let's move a little faster here. You can look at it on your own. Oh yeah, we should point out that one of the reasons we're not in the hard landing camp is usually when you get a recession, it takes a while for politicians to get a stimulus program going. This time around, the stimulus program got started before any recession showed up, and that's in all these infrastructure, CHIPS Acts, and so on. So there's a lot of money in the fiscal pipeline for state and local governments to spend that will keep the economy growing. Finally, on inflation, we still think it's moderating. It's moderating a little slower than we thought. We thought it would be the PCED inflation rate headline would be 6 to 7% in the first half, and then it would come down to 4 to 5% in the second half. Well, we got down to 5 by the end of last year, and now we're aiming for 3 to 4%. We know the goods inflation has come down a lot. It's the services side, but I think rent inflation is going to show signs of moderating in the first half of the year and actually moderate in the second half of the year. So here we have the the headline PCED, the core PCED. We like to look at the 3-month relative to the year over year, and we're clearly seeing signs that on a 3-month basis, the trend is to pull down the year over year. The year over year headline is 5%, as I mentioned before. The food and energy, same kind of story. Energy may kind of reverse here. We're seeing gasoline prices going up, but on the other hand, natural gas prices have come down. Maybe that'll offset that somewhat. Food inflation actually is moderating, though we are seeing the cattle prices and therefore beef prices are still likely to be going higher. But on the services side, we'll be writing more about it, and I'm sure Powell will talk about it because they got this hang up now about services excluding housing. And you can see that they are aware of the fact that the CPI and the PCED have this strange way of measuring rents. And it's as a result, it's going to take a while for rent inflation to moderate. It's still showing no signs of a peak on a year-over-year basis. It's starting to show some signs of a peak on a 3-month basis. So we'll see how that plays out. But we know that new leases are far lower, more like 3 to 4% inflation rate. Well, let's go, and I got 3 questions and I'll tackle them. So Doug, have you looked into the distortions in the job openings data caused by the remaining coronavirus stimulus money? My firm still gets solicitation calls and emails. Look, I think the pandemic kind of threw everything up into the air, caused a lot of things to behave in strange ways. I think we're still kind of working through all this to try to get back to some sort of normal. But you know, clearly there's still the issues of the long COVID issues that are affecting people's health. Maybe some people just don't want to go in, work with being surrounded by other people. I think COVID convinced a lot of baby boomers that you know, life is short and maybe it's time to retire and travel and take up hobbies, play golf, whatever. So I think it's still having an impact there. But you know, but the other thing is you can't deny that there's a real shortage of labor related to underlying demographic factors. We just don't have that baby boom pouring into our labor market. Quite the opposite. They are increasingly moving out of the labor market. Tim, Europe was able to secure energy resources for the winter, but what is their long-term plan for energy supply? Doubtful they will want to rely so heavily on Russia going forward when, if the Ukraine conflict is resolved. No, I think they're not going to go back to Russia for a long, long time. And I think they're scrambling, and they've succeeded to a large extent in sort of makeshift ways of bringing natural gas in. And so they've succeeded in doing that. There's no particular reason why they couldn't do that again next winter. They did have a very mild winter, so it's like sort of ironic if you know, climate change might have actually led to some a warmer weather situation in Europe and saved them from their climate change mistakes, which was to believe that they could just overnight go from renewables to away from fossil. Just didn't quite work out that way. Let's see. Thank you for your time. Do you expect to see operating margins taking a hit since companies cannot pass along the high cost? Well, the companies have been passing on some of their high costs, but I think there's some signs of resistance by the consumer to those high costs. Margins have been getting squeezed, but margins really take a dive in recessions. I don't think they're going to take a dive here in a soft landing scenario, but they have been coming down for sure, and that's really most. That really explains why that earnings chart I show you is going down. It's not revenues. Revenues are still getting a lift from inflation. Joe, can you still make a case for the roaring 2020s? Yeah, I can make a case for the roaring 2020s until the decade's over. Then then we'll look backwards. That story just didn't pan out. I'm thinking that we are going to see more and more businesses do what they've been doing, recognize that the labor shortages are chronic, realize that there's more churn in the labor market than in the past. Maybe some of it has to do with the way younger workers' attitude towards work relative to older workers. They're more willing to jump ship to look for something better. So I think technology, as I just showed you, 50% of capital spending now is technology, and I think it's actually more than that when you make some adjustments for other equipment being high tech. But put it all together, and I think technology will be the source of productivity gains, and that's a big part of the roaring 2020 stories. Just the way we had a big tech boom in the 1920s. Tech back then was things like cars and electricity and light bulbs and so on. This time around, we know about all the technologies that are out there that are and can continue to boost productivity, and we think that that's going to make it a roaring 2020s kind of scenario. It doesn't feel like it right now. Right now, it feels more like the 1970s all over again. But everything seems to be on fast forward. So maybe we'll fast forward through this pretty quickly, and 2024 will be sort of a transition year from what felt like the 1970s last year to what looks increasingly like the 2020s. I'll take a couple more questions. Brian, Ed, what impact does the increased money supply impact inflation? Some folks we follow are convinced inflation won't come down until money supply decreases substantially. Interesting, you're framing your question that way, because I get more questions the other way around, which is that the money supply isn't growing, and I tell them, yeah, it's not growing after it soared during the pandemic. If you just extrapolate the trend in M2 prior to the pandemic, you get that M2 currently is about $1 trillion above that trend. There certainly seems to be lots of liquidity in the system. Money market funds are all-time record high. Whenever you see the market going up a little bit, it suddenly goes up a lot. Seems like there's a lot of cash on the sidelines that has still this FOMO attitude. They don't want to miss out. They're scared of the market, but they don't want to miss out. So you kind of see that in the volatility of the market. No, I think inflation is partly a monetary phenomenon, but it's also a demographic phenomenon. It's also a globalization phenomenon, a productivity issue. I'm just not into the view that it's kind of a simple matter of the monetarist view that inflation is mostly always a monetary phenomenon. Okay, William, how do you see the rise in rates affecting the deficits? The deficit has been a problem for the 40 plus years I've been doing this. I've been in this business. There've been worriers and doomsters about the deficit. I've come to the conclusion that the deficit is generational theft. We're just kind of stealing from our kids. It's unfortunate. We shouldn't be doing it, but it is what it is. That's what we're doing. So I don't think it really has an immediate effect on our economy today. I think it'll be tougher for our kids to be able to borrow money as we add more debt to the government's books. But higher interest rates have already driven the interest cost of the government up from well, they're up to from 300 billion a couple of years ago to 500 billion on a 12-month basis, probably going to $1 trillion in the next couple of years. And that is very disturbing. But again, I think in a balanced view, you have to recognize that those interest expenses are being sent down to people who own government securities. So that's a bit of a stimulus, but it's not something that I expect that our politicians are going to deal with anytime soon. We have more questions here, but I've overstayed my welcome here. For those of you wondering, this is Max, on this side, Max, a present I got from my wife for the holidays. And I mentioned before that I see all these younger podcasters in hoodies, so I wanted to have my own hoodie, but this is a little classier than I think what some of my younger podcast competitors are wearing. So with all that, let me wish you a good week, and thank you for tuning in. All the best.